Dear viewers, last year was great for small caps. At the start of 2023, the small cap to Sensex ratio was at 0.46 times as compared to a long-term median of 0.43 times and previous peak of 0.58 times in January 2018, thus leaving a good runway potential for small caps. But as I record this, the ratio is way past that average. At 0.63 times, the small cap to Sensex ratio has already breached the previous peak of 0.58 in 2018. From that peak in 2018, the small cap index had crashed by more than 50%. It took 3 years for small caps to rebound to the same level. If I go further in the history of past peaks and corrections, the small cap index had peaked in 2008 at a small cap to Sensex ratio of 0.68 times. The correction from 2008 peak was 79%. It took almost 9 years post 2008 for small cap index to come close to those levels. So, what would make the small caps correct this time? For an answer to that, let's see what is fueling the interest in small caps. As per MFI data, for first 11 months of 2023, the inflow in small cap funds has been crazy. Rupees 372 billion from the funds have found their way to small caps as compared to an outflow of rupees 27 billion in large caps and rupees 215 billion inflow in mid caps. Do note that I am only considering the funds that are dedicated to large, mid and small cap schemes as individual buckets and not the ones under multi-cap or flexi-cap schemes. So, what do you think happens when a huge amount of money chases stocks with relatively low market caps and even lower liquidity? Well, it's PE or price to earnings ratio expansion. While earnings growth follows its course in line with the business growth, the prices run ahead, leading to gains that are more in the speculative zone. No wonder then that a PE of 40 or above seems to be more of a norm now for small caps. Small caps have limited capacity to absorb this kind of money. Furthermore, most of the funds are likely to be allocated towards well-known small caps that have the capacity to absorb this kind of money. This has led to a situation where the valuations of some of the liquid and well-known small caps have been pushed in the speculative zone. The growth prospects for the businesses in this set can barely justify the PEs that they are enjoying. Any kind of negative surprise on the earnings front or any external event that impacts the fund flows is likely to have a disastrous impact on such stocks. Now, history has shown limited ability of even genius investors to predict such events. When the ability to predict is limited, one of the most sensible investment strategies is to be mindful of valuation and have a strong margin of safety in your buy price. Caution and not greed should be the dominating sentiment while investing in small caps at present. And here are some more reasons why you should be cautious. You see, while big investors and institutional money can't get enough of Indian stocks, the insider activity has an entirely different tale to tell, and it's not comforting. In the recent months, and for most part of 2023, the insider trades are more skewed towards selling than buying. At rupees 1.1 trillion, it is almost 6 times higher than the insider selling in 2018. While the promoters are selling heavily, guess who is lapping it up? Well, it's the retail and institutional investors. Now, any shift in the sentiments or tightening of liquidity could lead to a sharp sell-off in the markets, especially in small caps. Now, I don't want to end this video just on a cautious note without mentioning some positives that I see. You see, even in these markets, when the small caps are rallying, there are certain companies with decent financial performance where the insiders are buying the stocks from the open market. I have included the ones in the slide where the current price is almost at par or at a discount from the average price at which insiders have purchased. These stocks include Som Distilleries, VIP Industries, ME Organics, Link Limited, RK Forgings, and Control Print. Do note that this is not a recommendation, but something for your watch list where the stocks deserve further attention and due diligence. With this, I would like to conclude this video. If you found this information useful, let me know through your likes. In any case, I would love to see your feedback in the comments section. For more such content, do subscribe to Equitymaster's YouTube channel. Thank you for watching. Goodbye.